Alrighty, I'm going to do a presentation right now on one of my favorite subjects, something I think about a lot ever since I was actually a teenager. I can't remember exactly when, but I am very interested in collateralized debt obligations. I think it's an incredible subject, it's vitally important for recent economic development, and I think it's a point of importance for historical observation. Collateralized debt obligations have affected the United States, and I would argue the rest of the world economy in a significant way. And they've also just been really fascinating to me. I mean, you get hooked onto something and you just like it since you're a teenager. And this is just a teenage love of mine that so to speak, is a teenage interest of mine that I like studying as a teenager. You pick up subjects that you like when you're young, and it's like reading a novel, and to me this is something incredible, and I've found a lot of enjoyment out of it, and I still do to this day. So it's collateralized debt obligation is part of the financial market. Just quick introduction. I'm going to try to actually make this somewhat basic so that anyone could understand it. I found a lot of these images from Wikipedia, and I don't own any of them. This is a picture of a stock market board, somewhat related, but just get your mindset going there. And here's a picture of New York City in 2005, from, I believe, looking south from the Empire State Building. I'm pretty sure. At least that's my idea. So first of all, let's start with the definition of a collateralized debt obligation. As it's written here, collateralized debt obligation, CDO as the common acronym goes, is a type of structured asset-backed security, ABS. It was originally developed for the corporate debt markets, and over time, CDOs evolved to encompass mortgage-backed securities. And that is one of the main things that has made it incredibly interesting for me. So, like other private label securities backed by assets, a CDO can be thought of as a promise to pay investors in a prescribed sequence, based on the cash flow the CDO collects from the pool of bonds or other assets it owns. The CDO is sliced into tranches, which catch the cash flow of interest and principal payments in a sequence based on seniority. I'll get more into tranches, but essentially in structured finance, tranche is one of the number of related securities offered as part of the same transaction. Just as a side note, it comes from the French, which means slice section. And it's sort of similar to the English trench, meaning like a ditch. But so transaction documentation is usually defines the tranches as different classes of notes. So you either have like Class A, Class B, Class C, and in a simple sense, Class A is most likely to pay, Class B is less likely to pay, etc., and so on and so on. So the CDO is sliced into tranches, which catch the cash flow of interest and principal payments into a sequence based on seniority. If some loans default and the cash collected by the CDO is insufficient to pay all of its investors, those in the lowest, most junior tranches, suffer losses, but at the same time, the last to lose payment from the default are the safest, and those are the most senior tranches. Consequently, coupon payments and interest rates vary by tranche, with the safest or most senior tranches receiving the lowest rates, and the lowest tranches receiving the highest rates due to compensate for the higher default risk. As an example, CDO might be issue the following tranches in order of safeness: senior AA, AAA, sometimes known as super senior, junior AAA, AA, A, triple B, and residual. So if that makes sense, AAA, senior AAA, you're good to go. Junior AAA, and then residual is probably not something you want to invest in, but you never know. I mean, it depends on what you're. I'm not giving any advice, and this video is not meant to give any advice about anything. It's just to examine an economical and historical aspect that has affected the United States. I should make that very clear. I repeat myself. It's not advice or anything. Anyway, separate special purpose entities rather than the parent investment bank issues the CDO and pay interest to investors. As CDOs developed, some sponsors repackaged the tranches into yet another iteration known as CDO squared, or CDOs of CDOs. Now, why this is important: in the early 2000s, CDOs were generally diversified, but by 2006 and 2007, when the CDO market grew to hundreds of billions of dollars, this changed. CDO collateral became dominated not by loans, but by lower triple B, and A or A tranches recycled from other asset-backed securities, whose assets were usually non-prime mortgages and known as synthetic CDOs. These CDOs have been called the engine that powered the mortgage supply chain for non-prime mortgages. And are credited with giving lenders greater incentive to make non-prime mortgage loans leading up to the 2007-2009 subprime mortgage crisis. And that's why it became incredibly interesting to me, because in high school I got to live and witness the 2007-2009 subprime mortgage crisis. So that's a nice picture, but we're not going to get into it just yet. Just some back history. Apparently, the first CDO was issued in 1987 by bankers at what is now a defunct Drexel Berman Lambert Incorporated for the also now defunct Imperial Savings Association. During the 1990s, collateral for CDOs was generally corporate and emerging market bonds and bank loans. After 1998, the multi-sector CDOs were developed by Prudential Securities, but CDOs remained fairly obscure until 2000. In 2002 and 2003, CDOs had a setback when rating agencies were forced to downgrade hundreds of securities, but CDOs grew from $69 billion in 2000 to around $500 billion in 2006. From 2004 to 2007, $1.4 trillion worth of CDOs were issued. Early CDOs were actually diversified and might include everything from aircraft lease equipment debt to manufacturing housing loans, student loans, credit card debt, and the diversification of these multi-sector CDOs was a selling point, as it meant that there was a downturn in one industry like aircraft manufacturing and other loans defaulted. Other industries like manufacturing might be unaffected. So it makes sense. So you divide these things up, and then you know, if one fails, the other one will be okay. Another selling point was that CDOs offered returns that were sometimes 2 to 3% points higher than corporate bonds with the same credit rating. So we really need to talk about why this was incredible in terms of why it incentivized people to. So there were incentivized people to invest in such collateralized debt obligations. So the advantages of securitization. It's collateralized debt obligation. Now we're going to talk about incentives. So the depository banks had an incentive to securitize loans as they originated, often in the form of CDO securities, because this removes the loan from their books. The transfer of these loans, along with the related risk of security buying investors and capital return for cash, replenishes the bank's capital. This enabled them to remain in compliance with capital requirements laws while lending again and generating additional origination fees. The global demand for fixed income investments from 2000-2007 worldwide, fixed income investments, meaning investments in bonds and other conservative securities, roughly doubled in size to $70 trillion, yet the supply for relatively safe income generating investments had not grown as fast, which bid upon bond prices and drove down the interest rates. Investment banks on Wall Street answered this demand with financial innovation such as the mortgage-backed securities, MBS, and collateralized debt obligations, which were assigned safe ratings by the credit rating agencies. Low interest rates, fears of the deflation, the bursting of the dot-com bubble, a U.S. recession, the U.S. trade deficit kept increased interest rates low from 2000, 2004, and 2005. According to economist Mark Zandi, that they kept the interest rates low, but the low yield of the U.S. Treasury bonds created a demand for global investors for subprime mortgages and mortgage-backed CDOs with a relatively high yields, but credit ratings as high as the Treasuries. This search for yield by global investors caused many to purchase CDOs, though they lived to regret trusting the credit agencies' ratings, because the ratings weren't always accurate. And there are many pricing models to kind of represent this. I first want to talk about, so we have two images that I'm going to return and talk about here. Basically what you got going on over here is you have collateralized debt obligations. They're structured instruments that pool together financial assets. So you got your AAA, BB, and whatnot. And you put them all together. If one fails, then there's other stuff to support it. So you repackage these, and the new pool of the no, excuse me, the of CDOs goes into even a bigger pool, and the CDO managers and securities firms, they pool those various assets and attempt to get diversification of benefits. And similar to the mortgage-backed securities, CDOs issued in securities in tranches vary based on their place in the waterfall. This is another way to represent it. So you have all these buyers, pool of mortgages, they're getting houses. Then you have they're rated. That's how they're rated. And then you have the risk of lowest loss, lowest risk, a lower expectation of yield, first loss, and you just kind of plan who's kind of going to fail first, and you plan to get your investment back. So here we have the theory of how the financial system works. I really love this chart. This is one of my favorite charts that I've ever seen in my life. I've actually seen this chart for multiple years. I believe in college. I may even seen it in high school. But as long as most mortgages all over the country and all different characteristics didn't default at once, which by the way happened in history, then there would be enough money. So you see these little red guys over here. They're defaulting, but everybody else is providing water or money. And people over the country take out mortgages. Financial industrial institutions group hundreds of subprime mortgages. Oh boy. Into the mortgage-backed securities. The securities are grouped into tranches by levels of risk and earnings potential for bondholders. When everybody can pay in their mortgage in each month, each group of bondholders get paid. The mortgage payments, so we're down here in this little water area, the mortgage payments are collected, oh boy, the mortgage payments are collected by financial institutions and payments distributed to bondholders at higher rates. The tranches are paid first. When monthly mortgage payments are not made, payments may not reach holders of low-rated tranches. So, these guys, the AAAs, they're most likely going to get paid. Yeah, less so. But, and then, just looking at this more closely, we're at number 4 right now. Collateralized debt obligations were created by taking the lower-rated tranches out of the MBS and repackaging them. Most of this CDO is highly rated, even though built out at risk assessments, and they're huge models to analyze these risks, like Gaussian cupola models, and you could use these models to price the CDOs. Another financial institution does the same thing with a risk analysis, and you set your price. So as you can see here, where a lot of them aren't paying, not everybody gets paid, but the AAAs usually get paid. This is a representation of security markets impacted during the crisis. As you can see, not that bad in the early 2000s. It got pretty bad in the later 2000s. The volumes of CDOs issued grow globally. It was high, and it hit its high point, arguably, in 2006, and then it went really low. I mean, it went down. And there's a lot of debate about this. I mean, that's why it's such a fascinating thing. That's why, I've talked about it almost every single class, from constitutional law in law school to property law, contracts, payment systems, secure transactions. I mean, it is just absolutely amazing. Not amazing in the awe-inspiring, as in, whoa, what happened? I mean, this is terrible. I mean, this is what many call the Second Great Depression in the United States. It could have been the Third Great Depression. You consider, I guess, other events, but it was really bad and not good. It's interesting. It's something I think we really need to sit down and study and focus on. And it's absolutely incredible. And there's so many financial innovations that govern this. I mean, if we look at the crash, here's the impaired securities. More than half of the highest rated AAA CDOs were impaired, which meant losing principal or downgraded to junk status, compared to the small fraction of similarly rated subprime mortgages and alternate A mortgage-backed securities. I mean, it was a serious issue. And I think understanding the history of why it expanded is of incredible importance. But I hope that helps understand what a collateralized debt obligation is. And then you can go out and analyze what actually happened as it increased in the early 2000s, and then late mid-2000s, things got really bad, why the market crashed, and you have this chart like this where everything was really high, and then it just dropped down unbelievably. And I mean, these were my high school years from 2006 to 2010. I mean, I guess it started decently well, economically speaking, and then it just and I'm glad I got to witness it. I was constantly reading the news and trying to understand what was going on. And in some theory, I still am in law school studying payment systems. I mean, a lot of the cases in payment systems are based off things that were happening like this, and it's very interesting.